If you're over 40 and are planning to start investing in 2026, then you might think the earlier you start, the better. But the reality is that investing too early can actually slow your wealth down if you don't focus on one crucial thing. I'm Paudie Kelly, I'm a financial consultant and economics professor, and in this video, I'm going to show you why not investing this year will actually increase your future wealth. Before we get into investing, it's useful to break down something that's sort of at the heart of all of this, and that's income. So let's start there. When we talk about income, we can imagine sitting on a spectrum, right, between active and passive. So on one side of the spectrum, you have active income. This is the income that directly requires your time and effort. If you don't show up, your income stops. You know, this includes your salary, your hourly wage, your freelancing, consulting work, anything like that, whatever it is. As long as you're trading time for money, it fits into this category. Now, on the other side of the spectrum, you have passive income. And passive income, in theory, means that it will continue with minimal effort once you set it up in the first place. Now, good examples of this might be stock market investing, right, rental properties, or potentially even a business that doesn't take your day-to-day time. Now, reality check here. Because this is a spectrum, we need to be realistic. There's no real true passive income. Rental properties still need maintenance and decision-making. Investing still needs discipline and education. The difference here isn't effort versus no effort. Instead, it's the difference between the ongoing time required relative to the income produced. Most beginners completely misunderstand this, and that misunderstanding only sets them up for disappointment. So it's crucial to understand the difference between active and passive income. Now, when most people say they want to start investing, what they really mean is they want passive income. They want their money to grow in the background while they focus on their career. They don't want to quit their jobs and become professional investors. They want to earn through their work and let investing quietly compound alongside it. Now, this goal makes complete sense, but here's what most people get wrong. And if you're over 40 and you're starting to plan to invest for the very first time in 2026, then this really matters. Active income has a higher ROI than passive income. So let me break that down. Because when most people think of ROI, return on investment, what they think in terms of percentages, 10%, 15%, 20%. But ROI isn't just about percentages. ROI is relative to what you put in. Time, effort, capital, risk. Passive income gives you a return on capital. The stock market doesn't care how smart you are. It doesn't care how hard you work. It doesn't care how motivated you feel. It pays you based on how much money you already have invested. But active income works differently. Active income gives you a return on your skills, your time, your leverage. And for most people, especially people later in life, this gives you a much higher return than passive income. And here's why. So if you invest in the stock market, the long-term average is, let's say, around 10%. Now that's a solid return, but it's capped by how much capital you have. 10% on $10,000 is $1,000. 10% on $100,000 is $10,000. Active income doesn't have that same cap. If you increase your salary by $10,000, then that has nothing to do with how much you've invested. It depends completely on your ability to create more value in the marketplace. This can come from upskilling, right? So you earn more money. This can come from taking on more responsibility, and so you demand a higher salary. This can come from even negotiating a pay rise. That's why if you're in the middle stages of life and haven't invested before, active income can have a higher ROI than passive income. Let's make this a little bit more concrete. Imagine someone earning $50,000 per year. If they focus on passive investing and want to generate an extra $5,000 per year from the stock market, and we assume a 10% return, they would need $50,000 already invested. With a salary like this, that $50,000 likely took years to save. But now let's compare that to active income. The same person could increase their income by $5,000 per year. That's a 10% rise by doing one of two things. They could negotiate their salary, or maybe they could switch to a better paying role. In many cases, the increase can happen in months, not years. And once it happens, it doesn't pay you once, it pays you every year going forward. If you think about it, that's an extraordinary ROI. In capital terms, it's almost infinite, right? You didn't need the $50,000 to start. All you needed was a little bit of time and effort. That's why people often underestimate ROI from active income, because they only look at the dollar outcome and they don't look at what it took to get there. Now, there's another difference that matters just as much, and that's probability. The probability of getting return by increasing your active income is very high. If you take reasonable actions, learn a valuable skill, get better at your job, move into a higher demand role, you will almost certainly earn more over time. The link between effort and reward isn't perfect, but it's pretty strong. But with passive investing, it's different. Stock market returns are based on long-term averages, not guarantees. So a 10% average return doesn't mean you'll get 10% this year. You could invest today and see negative returns for several years. You could invest heavily right before a market downturn. This is why sequence of returns matters. So while passive investing has strong expected returns over decades, in the short term or even medium term, it's a little bit more uncertain. On the other hand, with active investing, it's very controllable. You can influence the outcome, you can choose where to apply effort, you can choose which skills to build, you can choose which opportunities to pursue. From a risk-adjusted perspective, active income dominates passive income, especially when you're just starting out. And most people ignore this simple step, and that's why when they start investing, they see minimal results. So this leads me maybe to the most important point of this video, and that's the order in which these things are done. If you prioritize passive income before you maximize active income, then what you're trying to do here is you're trying to grow your wealth with the smallest possible engine. Passive investing works so much better when it has active cash flow, and active cash flow comes from active income. Think of active income as the engine and passive income as the multiplier. If the engine is weak, then the multiplier doesn't do much. But if the engine is strong, then the multiplier has a massive effect. And here's what most people don't get right, especially about this idea of order, is that starting later can actually mean you build more wealth than if you start earlier. Let's look at an example to solidify that. Let's compare two people. Person A earns $50,000 per year. They immediately focus on passive investing. They invest $5,000 per year. After 10 years, assuming a 10% return, they might have $80,000 to $90,000 invested. Person B takes a different approach. For the first 3 to 4 years, they focus on increasing active income. They invest in skills, they change roles, they negotiate. They increase their income from $50,000 to $80,000. Only then do they focus on passive investing. But now they can invest $15,000 per year instead of $5,000 per year. Over a 20-year period, despite starting later, person B ends up with more than double the wealth of person A. But this only happens if they focus on active income first. Therefore, sequencing is more important than starting early. If you're over 40 and you're only starting out now, this matters even more. You don't have decades to rely on time, so you need efficient returns. You need something that maximizes probability and size. That's why focusing on passive income can often be very disappointing, because small portfolios give small returns. You invest a few $1,000s, see minimal growth, and you sort of decide, yeah, investing doesn't work. But no, what doesn't work is skipping the first step of maximizing your earning potential. Increasing your active income gives you more money to invest, more margin for error, more resilience in downturns, and faster compounding later on. So the right mental model isn't active versus passive. It's active first, passive second. Active income is how you build wealth quickly and reliably, whereas passive income is how you preserve it and compound it efficiently. The truth is that the highest ROI investment that most people don't make is maximizing their earning potential. Once that engine is strong, then passive income becomes a lot more effective and a lot less stressful. That's the order that works. Okay, so now that you understand this, the question of course is, how do I pull this off in real life? How do I actually do this? And here's the truth, because what separates people with big results from everyone else is they don't just learn, they learn and implement. If you truly want to increase your income, then you don't need to wait for promotion or a pay raise. You can start here today. I've got this framework. It's called RISE. It's 4 actions you could take to increase your earnings. RISE stands for reduce, invest, solicit, exchange. Now, each one of these actions increase your earnings, so you can do them individually or you can do them in order to maximize the effect. So let me break it down. So first is to reduce expenses. So imagine a company, if they want to make profits, what they do, or one of the first things they do, is they cut costs. And you can do the same. Reducing expenses is effectively a pay raise. And in fact, it's significantly easier than negotiating one. For example, let's say you earn $50,000 a year and you're able to save $100 a week more. That's basically $5,000 a year, which is effectively a 10% pay raise without asking anyone for anything. So what this looks like in practice: track your spending, identify wants you can cut, automate savings into a separate account, and review this every few months. I'm gonna just say that again. What this looks like in practice: track your spending, identify wants you can cut, automate savings into a separate account, and then review this every few months. So the second part of the framework is I invest. And this is about investing in upskilling, because the idea here is that your professional value isn't fixed. It grows with your skills. You can change it. Now, the crazy thing here is that about 50% of employees don't actively learn more. They don't actively upskill, despite the fact that it would make them more valuable to their employer and to the marketplace. So the third stage here is solicit. Basically, solicit a pay raise, ask for a pay raise. This is the most underrated asymmetric action most people can take to increase their salary. An asymmetric action is basically one that has unlimited upside and limited downside. In this case, the unlimited upside is that you get a higher salary, but the limited downside is maybe embarrassment or potentially rejection. They just don't compare. And the curious thing here is that most people don't ask for a pay raise, but the people who do statistically get one. So what this looks like in real life: document your results, focus on metrics and improvements, prepare a clear case, and then have a professional conversation. Let me say that again. Document your results, focus on metrics and improvements, prepare a clear case, and then have a professional conversation. So the fourth and final stage is exchange. Exchange your company. Basically, switch companies. Believe it or not, the labor market values the same work differently. The studies and research are clear on this, that most people see the biggest jump in their salaries over time by switching companies, sometimes up to 20% more. So what this looks like in real life: keep your CV updated, keep LinkedIn current, check the market regularly, and apply when better opportunities appear. So remember, rise, reduce expenses, invest in upskilling, solicit a pay raise, and then exchange companies. So if you actively do this year, especially if you're older, then you'll maximize your active income and get a much higher ROI than you would if you invested passively. So if you take one thing from this video, it's this: if you're in your 40s and you're just starting to invest, then you need to understand that active income has a higher ROI than passive income. Passive income is powerful, but only when it's fed by a strong cash flow. On its own, passive income is a little slow, it's a bit uncertain in the short term, and then you're limited by the amount of capital that you have. Whereas active income is different. You can influence it directly, you can change it faster, you can increase it more reliably. This isn't an argument against investing. This is an argument for the right sequencing. You can even think of it like this: it's not active versus passive. It's active first, then passive. Most people over 40 struggle with investing, not because they're bad investors or they don't know how, but because they skip this first step of maximizing their active income capacity. Before your money works for you, make sure you're working at the highest possible rate. That's the foundation, that's the leverage, that's what works.